Hey, this is Hutch with BankingTruths.com, and today we're going to talk about using life insurance as your own bank, specifically as it relates to real estate investors or private money lenders. I realize it sounds a little bit scammy, a little bit spammy, and I can promise you it's not. In fact, by the end of this video, you're gonna see that for every hater out there like Dave Ramsey, there's some really big institutions that love the use of life insurance to help with their own banking functions. And throughout this series, our goal is to help put some details to the concept so that you can make a more informed decision regardless of who you end up working with. All the information is so guarded. You either hear from haters or you hear from people that sell it, and including myself. And so you feel like it's a little biased. And so we're going to give you the knowledge and the tools so that you can make a good informed decision for your family. So one of my early mentors once told me, Hutch, if you get the concept, the details are irrelevant. And if you don't get the concept, well, the details will always be irrelevant. I think it's important that you understand the concept and the history of this infinite banking concept. And by the way, that term was coined by a gentleman named Nelson Nash, who wrote a book called The Infinite Banking Concept, Becoming Your Own Banker. I think in honoring the original spirit of Nelson's book, removing your dependence on banks is going to be very, very important. It's a great saying by Bob Hope, who said, "A bank is a place that will lend you money if you can prove you don't need it." And how true that is. So I was around with a HELOC in 2008, 2009. I wasn't even at 50% capacity on my HELOC. I was probably borrowing about 35%. I was current on my payments, and lo and behold, they took it away from me. And it's like, wait a second, I was counting on that liquidity, but there was nothing I could do. They had all the control. And although you may be able to have access to these credit products now, you can't always count on it, especially when the best generational buying opportunities come about. That's when the sky's falling, markets are down, the housing market, the stock market. But by starting to use some of your working capital and build up your own bank, you can start to declare your independence from banks before they declare them from you. Anyway, you know what I mean. The other thing that you're going to want to declare your independence from is the tax system to a degree. And you can't, if you're an American citizen, wherever you go in the world, you technically owe tax unless you use some of the legal tax shelters. And unfortunately, with IRAs, Roth IRAs, all of these vehicles where they allegedly give you some kind of tax forgiveness, it's all predicated on the fact that you're not going to use it until this mythical time called retirement after age 59 and a half. But that's not the case with life insurance. So you can start to build up your working capital, continue to keep it compounding within the policy even while you're borrowing against it. And the money while it's growing in the policy will not be taxed while it's growing in there or while you're using it if you use the system properly. And this is really, really important because even though there's high yield savings accounts now paying 5%, for the better part of the last decade and a half, my savings account, my interest rate started with a dot. So this 5% thing's new, but if you really think about 5%, you would need to earn like 7.5 or 8 to have it feel like 5. And so with life insurance, if you can get a true 4 or 5%, even in this environment, it feels like you're earning a bigger number. If you're one of the most successful people out there, it's gonna feel like double. If you're earning 4.5 or 5%, that's gonna feel like earning 9 or 10%. And so declaring your independence from the tax system for this pool of working capital that you plan to stack assets with is a huge leg up. It's a huge advantage. Again, we're trying to build a bigger bank that they can't take away from us. We can do that with life insurance, but even while you're using it, your bank continues growing inside of the policy, provided that you continue to be an honest banker, as Nelson used to say, by making it whole again, by paying down the loans. Now, I will say there is some talk about, hey, you're paying yourself interest, and it may feel like that because your money continues compounding, even though you're using it for other things, but you're not paying yourself interest. And I think there's some myths around this banking strategy that sound really good, make it really marketable. And what we plan to do is really demystify things. So going back to declaring your independence from banks, I think in the original spirit of the infinite banking concept, they were saying just remove yourself completely. And that can be a little inconvenient, but not only that, not always efficient. If there can be advantageous debt tools we can get that banks are offering, we want to use them. I had a business owner client that got it, like it clicked for him, and he had lines of credit and had bankers approaching him all the time, and he said, wait a second, Hutch, so you mean to tell me if I build my own bank and I got these bankers in suits coming in here trying to get me to take their loans, I can tell them, you better sharpen your pencil, buddy. And I said, yeah, that's it, you got it. But my partner Ben, he was able to really take advantage of some opportunities where it was shortly after the COVID pandemic started. He wanted to purchase in Nashville. He has family there. He was going back there. It was a hot market, and there were bidding wars on these rental properties. And he could have qualified for traditional banking, but then he would have been in line with everybody else. But he was able to swoop in there with some cash offers using his own bank and using a combination of products to come up with cash and then refinance it on the back end using a series of debt tools. But just having his own bank in place, proactively, having the foresight to set that up now allowed him to acquire these properties way below market and have them appreciate. And we are coming up on an opportunity where there could be generational buying opportunities. Who knows when? There's a lot of manipulation with the system and keeping this whole global house of cards going. We saw some evidence. Japan just talked about raising their interest rates a couple weeks back, and all of a sudden the economy started faltering. And then they said, well, wait a second, just kidding. There's turmoil in the Middle East. I don't mean to bring the room down, but I'm just saying things are happening to where if you wait to react, you're going to be in line with everybody else, versus if you have the foresight to start to remove and declare your independence from banks now, use them for what they're good for, that could pay large dividends later on. So the tagline for our company, bankingtruths.com, is don't do what banks say, do what they do. Now, if you think about what you're doing as being similar to what a bank does, a bank borrows money from the Fed window and then they go lend that dollar out multiple times on the dollar to collect multiple income streams. Whether you're a real estate investor or you're doing private money lending, isn't that what you're doing? Is you're actually borrowing someone else's money and you're trying to get multiple bites at the apple with that by using strategic leverage. Meanwhile, your full assets are compounding in your reserves. Well, you guys are really becoming your own bank. Now, what's interesting, if you look at the balance sheets of the two biggest banks in America, we'll start with Bank of America. They like real estate investments. So it says right here, real estate, you can see that's a big number. We scroll down and we look at life insurance assets. They actually call it an asset, and that's a big number. Just so you know, that isn't millions of dollars, that's dollar figures in thousands. That's billions of dollars. And that's not death benefit either. It wouldn't show up on a balance sheet. That's how much cash value they have. And they have to have it. In order to lend, you have to have reserves. If we look at Wells Fargo, same thing. Real estate, life insurance, right? They're doing the same thing. It's like, wow, wait a second. Why are they doing this? For some of the same reasons we already talked about. They're getting a very competitive growth rate. Even when banks were paying savings accounts or CDs that started with a dot, life insurance was paying very attractive rates. Those rates almost feel like double or 1.5 depending on your tax bracket because of the tax forgiveness. Now, the less sexy part is the protection benefit. And I realize most of you are saying, like most of my clients, I don't really care about the death benefit. I'm just doing this for the cash approach. But if you think about it, a bank, in order to get these products, they can't just get them on anybody, by the way. They have to get them on a key employee. Now, arguably, you're more key to your small business, your family in this lending venture, because if you were to pass away, they wouldn't really know what to do. So having that key person death benefit, protection benefit is going to be vital, versus like the top 5 executives could go down in a plane crash of Bank of America, Wells Fargo, and they're going to be fine. Now, here's where the proof's in the pudding. If you go to Google and type in Walmart life insurance lawsuit, you'll see that Walmart liked this idea so much, this is like in the late 90s, early 2000s, that they took out tons of life insurance policies on non-key employees, janitors, cashiers, and like, you're not supposed to do that. I'm not suggesting that anybody do anything illegal, but what I want you to see is that Walmart liked this idea so much, something really good is going on here. And talk about asset stacking. They were growing their inventories, their warehouses, their trucks, their retail stores. And so they had all this velocity, and they realized rather than make banks rich, they could do this themselves. Thankfully, you guys are already way ahead of the game in terms of how the lending side of the equation works. Now you just need to better understand this insurance side. And why this is so important for real estate investors and private money lenders is because although you're growing your net worth, you're doing so with illiquid assets. And it's really important to have a pool of liquid capital that can continue to oil your machine, something that can't be taken away from you during the worst of times. And during the best of times, when the best buying opportunities there are, you can dip into there and take full advantage of them. Not only that, but this tax situation is just going to keep getting worse and worse, like the debt situation. So having a pool of capital that is completely immune to this possible erosion can help you not only have a bigger bank on an ongoing basis, but can help you pull emergency income where it may be too penal to pull from these other sources. So I hope you enjoyed this intro video in this series, and stay tuned for a more detailed analysis.